All right, let's get right into it. I'm an analyst with Optivest, and today we're digging into something that can absolutely tank a company's stock value, but it often flies under the radar. We're talking about technological negligence. It's when a company talks a big game about the future, but is really just stuck in the past. And trust me, the cost isn't just about missing out on some cool new thing. It's a direct hit to your wallet, to the bottom line. So to see exactly how this works, we're going to open up a case file on a pretty well-known Sri Lankan company, Lakehouse Printers and Publishers, or LPRT.
So to really frame our investigation, let's start with a foundational idea from an absolute legend in investing, Philip Fisher. Now, he was saying this decades ago, but it's more relevant than ever. He basically argued that a company's commitment to tech and R&D isn't just some nice-to-have bonus. No, it's a matter of survival. It's non-negotiable. It's just like the quote says, if you're not looking to the future, you won't have one. And today, we're going to see exactly what that looks like when we get to the numbers.
And that really brings us to the core question here, doesn't it? This is something every single one of us as investors has to ask. Not just about the company we're looking at today, but about everything in our portfolio. Is a company's failure to keep up with technology silently, slowly sinking your stock? Well, let's find out.
Okay, so let's open the case file. We're looking at Lakehouse Printers and Publishers, PLC, or LPRT for short. For those in the Sri Lankan market, this is a name you'll probably know. It's publicly traded on the Colombo Stock Exchange.
Now, LPRT has its fingers at a few different pies, but for what we're looking at today, you can really think of it as a company split right down the middle. It's kind of like a tale of two businesses under one roof. On one hand, you've got the old-school traditional security printing stuff, and on the other hand, you've got what's supposed to be its future, the modern technology division.
So yeah, you can see the whole shebang here. Printing, tech, trading, even plantations. But listen, the two parts we really need to focus on, the ones that are supposed to be driving the whole operation, or, as we'll see, failing to drive it, are the security printing division and this so-called Lakehouse Technologies. They're the heart of the business.
Okay, now this is where it gets really interesting. Just look at these numbers for the 2024 financial year. The technology division wasn't just some small part of the company. It was basically the entire company. A whopping 80% of all net revenue came from Lakehouse Technologies. So let's be crystal clear. This company's success or failure is completely 100% tied to how good they are at technology.
All right, so we've got the lay of the land. We know what the business is supposed to be. Now let's dig into the story. What is the official narrative coming from management? What are they telling their shareholders? For that, we're going to go straight to the source, the annual report.
And here it is, right from the chairman's review. When talking about their traditional business, listen to the language they use. The market is flat. There are strong competitors. You see what's happening here? They're pointing fingers outwards. It's a classic reactive narrative, not a proactive one. Now, from my perspective as a forensic analyst, that kind of language sets off alarm bells immediately. It makes you ask a critical question. Is this management telling us they have a plan to innovate and fight back? Or are they basically just admitting that they're getting beaten by competitors who have better tech and more resources? Is it a strategy or is it an excuse?
And look, to try and seem more modern, they even did a rebrand. Their main division went from security cards to the much fancier-sounding Lakehouse Technologies. But here's the thing, right? A new name is just a new name. It's window dressing. Real innovation, the kind Philip Fisher was talking about, that takes real, consistent investment. It's about what's under the hood, not the logo on the door. So let's stop looking at the name and start looking at the numbers.
And this, right here, is the absolute core of our investigation. It's the gap, the giant chasm, between the story management is telling and the story the cold, hard data reveals. This is where you find out what's really going on.
And here it is, the smoking gun. In just 1 year, one single year from 2024 to 2025, the company's group net revenue fell off a cliff, a staggering drop of 32.4%. Let's be real, that's not a dip, that's a full-blown collapse. So what does that 32.4% actually look like in real money? We'll take a look. Revenue went from over 1.9 billion, that's billion with a B, Sri Lankan rupees, all the way down to under 1.3 billion. That means over 600 million rupees in revenue just, poof, disappeared in 12 months. Gone.
But here's the real kicker. You remember how the chairman blamed the flat market for their old printing business? Well, that part of the business only dropped by about 21%. The biggest nosedive, the absolute catastrophe, was in Lakehouse Technologies. It plummeted by almost 35%. Think about that. The one division that was supposed to be their future, the one with the fancy new name, that's where the bleeding was the worst. It's just unbelievable.
Okay, so what do we take away from all this? How can you use this case to protect your own investments? Let's break it down into a few clear, actionable warning signs that you can look for, and we'll tie it all back to those timeless ideas from Philip Fisher.
So here's your quick and dirty 3-point checklist. Number 1, analyze the language. Listen to what management is actually saying. Are they talking about proactive innovation, or are they just blaming flat markets and tough competitors? Number 2, look for the innovation revenue gap. Do the numbers actually back up all their talk about technology? Does the revenue match the narrative? And number 3, this one's absolutely critical. Question the R&D commitment. Are they actually investing money to stay ahead, or are they just coasting on old systems and hoping a new name will fool everyone?
And really, it all boils down to this one final question, doesn't it? It's the question this whole case leaves us with, and it's the one you should be asking about any company in your portfolio, especially one that's struggling. Is management actually fighting to innovate and win, or have they just given up and are now just managing the decline? The answer to that question could be the difference between a huge win and a painful loss.
Okay, and just before we wrap up, I have to make the standard disclaimer. This analysis is for educational purposes only. All the data we've looked at today comes directly from publicly available reports that anyone can access. And for the record, we at Optivest have absolutely no vested interest or financial position in LPRT PLC.
So, if you got something out of this forensic deep dive, do a favor for your fellow investors and share it. The more of us who learn how to spot that dangerous gap between a company's story and its reality, well, the better and more transparent our markets will be for everyone. Thanks for joining me.